Chapter 1. The Morning the Numbers. Lie. You wake up in Singapore and nothing is technically on fire. No riots, no tanks. The coffee still costs more than your childhood home. The skyline still sparkles like a brochure that's been aggressively photoshopped. And yet your assets are dead. Not robbed, not seized, just quietly euthanized by math. Your brokerage app refreshes. Again. Still loading. The little spinning wheel looks calm, almost polite, while your portfolio flatlines. Blue chip stocks wobble like drunk uncles at a wedding. REITs that promised stable income now whisper excuses. Bonds? Bonds are suddenly performance art. This is how financial death works in civilized places. No screaming, just decimals moving one place to the left. Singapore built its religion on numbers, GDP, credit ratings, net worth, asset-backed confidence. People don't ask how you feel here. They ask how much you're worth, and they expect the answer to appreciate annually. So when the numbers fail, the faith collapses. The official channels will call it a temporary repricing event. The analysts will say, markets are adjusting to new information. The influencers will tell you to zoom out. But zooming out doesn't help when your retirement just turned into a motivational quote. This city-state runs on leverage wrapped in discipline. Your CPF is invested. Your pension is exposed. Your savings are politely deployed into markets managed by entities that speak in reassuring acronyms like Monetary Authority of Singapore, Temasek, and GIC. You trusted them because you were trained to. From school rankings to property prices, everything here teaches the same lesson. If the system looks clean enough, it must be safe. And that's the trick. Property is not a home in Singapore. It's a leveraged bet with air conditioning. Stocks are not ownership. They're confidence with a ticker symbol. Cash is not safety. It's just waiting to be volunteered into productive use. One morning, the volunteering ends. Capital flows reverse. Liquidity evaporates. Foreign money blinks first, because it always does. Locals are told not to panic, which is how you know panic is already late. Your condo didn't shrink. Its price just discovered gravity. Your diversified portfolio turns out to be diversified in name only. Your net worth still exists on paper, which is comforting if you plan to eat paper. This isn't collapse. Collapse is dramatic. This is worse. This is normalization. Singapore's financial miracle depends on perpetual belief. Belief that assets only go up. Belief that governance can outsmart cycles. Belief that being smart and obedient exempts you from history. History does not care how efficient you are. And here's the part nobody tells you in glossy reports. When a system optimized for capital finally betrays capital holders, it doesn't fail loudly. It smiles, adjusts a formula, and calls it prudence. If this feels uncomfortable, good. That means you're still awake. Because in the next chapter, we're going to talk about who gets out, who gets locked in, and why the phrase world-class financial hub starts sounding like a warning label. If you want chapter 2, type OK. And before you pretend this is just entertainment, hit subscribe and like. Algorithms reward early believers. So do markets. Chapter 2. Exit is a privilege, not a right. Here's the first lie people learn about finance. You can always exit. Sell the stock, rent out the condo, move the money, fly somewhere cheaper, reset, breathe. Very comforting, completely false. Exits exist only when everyone doesn't need them at the same time. The moment confidence cracks, liquidity becomes selective. Not gone. Selective. Like a nightclub with a dress code, you suddenly fail. Capital still moves. Just not for you. Foreign funds leave first. They always do. They have lawyers, structures, and temporary reallocation emails drafted months ago. Their money exits Singapore at the speed of light and reappears somewhere boring and safe like US treasuries or Swiss boredom. Retail investors stay because retail investors are loyal, also trapped. Your brokerage app doesn't crash. It works perfectly. That's the insult. You can see the prices falling in real time while being reassured this is a healthy correction. The spread widens, the bids thin out. You sell lower than expected, then lower than acceptable, then not at all. This is when you discover the hierarchy. At the top, institutions with direct lines to liquidity. Below them, accredited investors with access to private opportunities. Below that, high-income professionals who were told they were sophisticated. At the bottom, everyone who followed the rules. Singapore is excellent at rules. The property market is where the illusion really breaks. For decades, real estate here wasn't shelter. It was policy with marble floors. Prices rose because they had to. Not because demand was infinite, but because leverage, immigration narratives, and carefully calibrated optimism said so. Then transactions freeze, listings multiply, viewings disappear, agents start using words like motivated seller and long-term value in the same sentence. Banks tighten quietly. Valuations lag reality because admitting reality would upset balance sheets. Your condo hasn't lost value, they say. It's just between price discovery moments. This is when people realize something uncomfortable about CPF. It's not a vault, it's a pipeline. Your retirement money isn't sleeping, it's working. Working in markets that assumed eternal stability. Nobody stole it, nobody mismanaged it. It's just exposed, and exposure is harmless until it isn't. The government response is calm, rational, and terrifying. Statements about resilience, long-term fundamentals, stress-tested institutions, all technically true, none immediately useful if you need cash now. This is the cruelty of a hyper-efficient system. It doesn't collapse, it recalibrates, slowly, patiently, while households absorb the shock one mortgage payment at a time. You were told Singapore rewards discipline. It does, just not during exits, because exits favor speed, not virtue. If you think this chapter is pessimistic, relax. We haven't even talked about currency risk, capital controls light, or what happens when confidence leaks into exchange rates. Chapter 3. When the currency starts, whispering people think collapse announces itself with sirens. It doesn't. It clears its throat. Currencies don't scream. They drift. Softly. Politely. Just enough for officials to call it movement, and for exporters to call it helpful. By the time households notice, the purchasing power is already gone, like a wallet you technically still own. Singapore's pride isn't just wealth, it's stability. The idea that the Singapore dollar is boring, predictable, well-behaved, the kind of currency that wears a tie even on weekends. That reputation is an asset, and like all assets, it depends on belief. Here's the uncomfortable math nobody likes to say out loud. Singapore imports almost everything: food, energy, labor. Inflation here doesn't arrive politely, it flies business class. When the currency weakens even slightly, costs jump immediately, while wages stare back blankly. Officials explain it's managed. Traders explain it's priced in. Households explain it by skipping items at the supermarket. A currency doesn't need to crash to ruin you. It just needs to lose its edge while your liabilities stay fixed. Mortgages don't adjust for vibes. Tuition fees don't accept confidence. Your portfolio being denominated in local currency stops feeling patriotic and starts feeling claustrophobic. This is where asset illusion meets daily life. Your stocks fall in global terms, not just local ones. Your overseas investments hedge, but too little, too late. Your savings buy less, quietly, every month. And no, this isn't Venezuela. Calm down. That comparison is for people who need drama to understand danger. This is subtler. This is a controlled descent where nobody panics publicly and everyone adjusts privately. The middle class feels it first because the middle class always does. Too rich for help, too exposed to hide, too leveraged to move fast. Expats notice next. Suddenly Singapore feels expensive in a way that doesn't impress anymore. The narrative shifts from premium hub to overpriced convenience. Contracts don't renew, talent rotates out, capital follows people, not press releases. This is when the confidence loop breaks. Currency confidence depends on capital inflow. Capital inflow depends on opportunity. Opportunity depends on growth that isn't just accounting magic. When that loop stutters, the currency doesn't collapse, it leaks. And leaks are deadly because nobody treats them as emergencies until the floor caves in. The response remains calm, always calm. Singapore is very good at calm. Calm speeches, calm data, calm reassurance that volatility is temporary. Temporary is doing a lot of work here. If this makes you uncomfortable, excellent. Financial literacy begins where comfort ends. Chapter 4 is where it gets personal. Households, debt. The part where people realize their biggest investment wasn't a stock or a condo. It was the assumption that tomorrow would look like yesterday. Chapter 4. The household balance sheet is the battlefield. Macroeconomics is fun when it's abstract. Charts, percentages, serious people pointing at screens. Then it walks into your living room and sits on your sofa. This is the chapter where Singapore's financial story stops being national and becomes painfully domestic. Households here are not poor, they are leveraged. That's different. Leverage works beautifully when assets rise forever, interest rates behave, and employment stays boring. Singapore optimized for all three, which is impressive, also fragile. Mortgages are the centerpiece, long tenures, high principal, manageable monthly payments that assume nothing weird happens for 25 to 30 years. A bold assumption in a global economy that treats weird as a hobby. Public housing owners feel safe because it's HDB. Private owners feel safe because it's prime. Both groups share the same exposure. Debt doesn't care about branding. When asset prices stall, debt doesn't flinch. When interest rates rise, debt smiles. When wages stagnate, debt clears its throat and waits. Banks stay calm. They always do. Loan officers speak gently. Restructuring is offered. Extensions are possible. Everything is framed as cooperation. What they don't say is that the system is designed to protect balance sheets first and households second. That's not evil. That's finance. Consumption shrinks quietly. Restaurants feel it before newspapers do. Luxury malls feel it before hawker centres do. People still go out, but they order differently. One less drink, one less upgrade, one less impulse buy. That's how recessions actually start. Not with panic, but with restraint. Families discover their real vulnerability wasn't market volatility, it was concentration. Most of their net worth tied to one asset, in one city, under one policy regime, funded by one income stream. Diversification was something they read about, not something they lived. The psychological shift is brutal. Singaporeans were taught that if you study hard, work hard, and follow policy signals, the system will reward you. That belief created stability. It also created obedience, and obedience is expensive when conditions change. You don't revolt. You internalize. You cut spending. You delay plans. You tell yourself it's temporary. Everyone does this at the same time, which is how demand collapses without a single dramatic headline. The scariest part? This all looks responsible. From the outside, Singapore still looks fine. Clean streets. Functional trains. No chaos. That's why this hurts more. Pain without spectacle doesn't attract sympathy or urgency. It just stretches. This is when people realize the truth about financial hubs. They are amazing at creating wealth. They are less enthusiastic about protecting it once it's already counted. Chapter 5 is where the illusion finally cracks. Reputation. Global perception. What happens when the world stops believing the story, not because it's false, but because it's tired? Type OK for Chapter 5. And if this is making you rethink your own balance sheet, like and subscribe. The market won't warn you. The algorithm might. Chapter 5. When the brand Stops Working Singapore didn't just sell assets, it sold a story. Safe, efficient, predictable. Adult supervision for capitalism, the kind of place money parks itself when the world feels messy. For decades, that brand worked so well, people forgot it was marketing. Then the phone stops ringing. Global capital is emotional. It pretends to be rational, but it falls in and out of love like a teenager with spreadsheets. When the story gets stale, money doesn't argue. It leaves. Not dramatically, casually. The tone shifts first. Articles stop praising and start reassessing. Reports begin using words like mature, which is finance code for we're bored. Think pieces appear in places like Bloomberg and Wall Street Journal asking whether Singapore's model has peaked. That's when you should worry, because once a financial hub loses narrative momentum, it has nothing left but efficiency. And efficiency alone doesn't attract speculative capital. It attracts accountants. The rich don't panic. They pivot. Family offices quietly diversify elsewhere. New money chooses Dubai, Miami, somewhere louder, somewhere with growth stories instead of governance stories. The irony is brutal. Singapore did everything right, too right. It optimized risk away until there was no upside left worth the exposure. Capital doesn't want perfection. It wants asymmetry. Big upside, manageable downside, and a good story to tell investors. Stable forever is not a story. It's a brochure. For locals, this is the final insult. You followed the plan, bought the asset, paid the tax, trusted the institutions, and now the payoff isn't collapse or reward, it's stagnation with good manners. Your assets still exist, they're just unimpressive. That's the real financial death, not losing everything, losing momentum while still being told you're lucky. The skyline remains, the laws remain, the order remains. What disappears is inevitability. The assumption that Singapore must win because it always has. Markets don't reward discipline forever. They reward novelty, risk, and timing. Discipline just delays the bill. This entire story isn't a prediction. It's a warning dressed as fiction because warnings are easier to swallow that way. If this made you uncomfortable, good. Comfort is expensive. If you want more long-form, unapologetic dissections of money, power, and the lies we call stability, subscribe. If this hit too close to home, like it anyway. Algorithms love anxiety almost as much as markets do. This was One Morning Your Assets Become Worthless. Singapore's financial death. And no, this wasn't about Singapore. It was about anyone who thinks a perfect system means a permanent one.